Hi guys, so you've decided that you need private health insurance after considering all of your options and are interested on how to keep the cost as low as possible? In this video, I'm going to show you the 5 best ways I reduced my gold level hospital private health insurance premiums by 44% off the standard price for all members. These methods are simple, available to most people, and take only a short phone call to set up. If you want to learn how I've kept my insurance premiums at almost half the average health fund member, then stick around and I'll show you how I did it. Welcome to another video from Money with Dan. To see my new videos, then remember to press the subscribe button and select to receive notifications. It's free. Also, if you'd like to see more videos like this from me, then please also hit the like button to let me know. Here are my 5 best tips to save money on your insurance premiums. Tip number 1. Did you know most health funds can offer discounts up to 12% if you meet a very simple criteria? Does your fund offer a discount for paying by direct debit instead of BPay? According to CanStar, 46% of funds offer this type of discount. Also, see if you qualify for a corporate discount through your employer, an association or club you belong to, an insurer, your bank. As an employee of a big company, HCF gives me 8% discount for simply working at a particular company. You can also get a discount for being aged simply between 18 and 29, up to 12% in some funds. If you're not getting a discount, I recommend that you contact your fund and see what's available, and if not, shop around. By doing a little research on your fund, you are likely to qualify at least one type of discount, or else you might want to consider changing health funds. Tip number 2. Look for plans that allow you to raise and decrease the excess you pay to lower the ongoing monthly premium. The objective of an excess is to pass some savings back to members who use their hospital benefits infrequently and are willing to take on some of the insurance risks themselves. What is an excess? Having an excess means that if you do need private hospital surgery in any year, then you would need to pay your health fund either $250, $500, or $750, depending on what excess you choose. You can choose which excess you prefer, and each has a different discount applied to the monthly premium. How much of a discount can you expect to get by increasing your excess? Well, if you choose to have an excess of $250 on a gold plan with HCF, for example, you could save $25 per month, or 6%. If you bump up the excess to $500, you could save $53 per month, or 12%. There is also the $750 excess option, which could save you up to $70 per month, or 16%. Now that is usually all you pay extra for one hospital visit, excluding any other related gaps for the private hospital procedure, like doctor fees, that you would pay anyway. However, depending on your plan, you may have to pay a second excess for a second visit to a private hospital in a year. Most plans do cap the excess payments at up to twice per year, and some exempt children entirely from this excess. With these savings from adding an excess, it would take 10 months of premium savings to pay for a one-off private hospital visit if something unexpected happened, compared to having no excess at all. If you had 2 visits, you would need to pay a second excess, and that would take about 20 months of premium savings to pay off. The longer you go between private hospital visits, the more the savings add up over the years. Remember, procedures in private hospitals are not emergencies, and are usually planned elective procedures only. If you do have a hospital emergency, it's likely to be in the public hospital system, and your private health insurance wouldn't matter anyway. Having an excess is also ideal for members that have a cash emergency fund in place, and who can afford a higher upfront cost if a surprise private hospital visit is required at short notice. Now, of course, if your circumstances do change and you expect more hospital visits in the near future, then you can elect to remove the excess and start paying a higher ongoing premium instead. The choice is yours. Tip number 3. You can always rely on Australia's world-class public hospital system for free with Medicare, with no income tax penalty, until you earn either more than $90,000 for a single or $180,000 for a couple or family. The tax penalty in this situation is called the Medicare Surcharge Levy and is payable when you lodge your tax return each year. The Medicare levy surcharge starts at 1% and increases up to a maximum of 1.5%. Depending on your annual income. The family income threshold for single parents, couples and families is increased by $1,500 for each dependent child after the first child. So if you're a high income earner, this surcharge can really get expensive. The cheapest private health insurance I could find for a single was $948 per year for the most basic plan available. This is the bronze category. This means you would break even with having private health insurance if you earned more than $94,800 by not paying the Medicare surcharge levy. The cheapest fund I could find for a couple or family was $2,304 per year for the most basic plan available. This means you would break even with having private health insurance if your total family income earned in a year is more than $230,000 combined. However, beware that there are other penalties once you are aged over 31 and don't have private health insurance, regardless of how much you earn, if you eventually decide to get private health insurance. This is because you'll be forced to pay a 2% loading for every year you are aged over 30 that you don't have private health insurance. This can be very expensive, particularly if you believe you will eventually be a high income earner later in your career. However, if you are happy with Medicare and never expect to earn anywhere near these income thresholds, then this is not going to be a big deterrent for you. Tip number 4. If you are eligible, you may also be able to save money by staying with your parents' policy instead of having your own policy at no extra cost to either you or your parent, where they maintain a family insurance policy. Changes announced in the federal budget mean insurers are allowed to increase the age until which a dependent can stay on their parent's policy from age 25 to 31. These changes came into effect from 1 April 2021. This means a young person could have private health insurance cover and could potentially save the average annual premium of $2,940 for a singles gold hospital and extras policy by being covered under their parent's policy at no extra cost to you or their parent, depending on whether they want to keep their family cover. The longer you can avoid taking out your own policy, the more you can save while you're young. Tip number 5. Have hospital-only cover and exclude cover for extras. The Medicare levy surcharge only applies if you don't have hospital-only cover. Having extras cover does not impact the Medicare levy surcharge. If you think you are unlikely to claim for things that extras cover, like dental or chiro, then this cover is an extra cost that you are not getting a benefit from. If you remove this cost, then you could save between $5 to $30 per month, or $60 to $360 per year, depending on the type of extras cover package that your fund offers. This can be a further saving between 1 to 10% off your premium. However, there may be a break-even point where basic extras cover makes sense to keep, such as routine dental checkups and a clean and fluoride treatment, which can cost about $100 per person per year, depending on your dentist. If you are a family of 4, then the $400 per year that you would pay in dental fees is enough to make it break even of having basic dental coverage. And if you need any other claim for things like chiro or remedial massage, then you'll be even further in front. If you don't plan on using any of these benefits ever, then removing it is a good idea because it's costing you money for something you don't get a benefit for. One last bonus tip: pay your health insurance premium as a lump sum in advance, which could earn you a discount of up to 4% when you prepay 12 months worth of insurance. This discount is higher than the interest cost on most mortgages at the moment. However, this discount isn't widely available, with only 5 health funds on CanStar's database currently advertising this feature. The funds that offer this currently are Australian Unity, HBF, HIF, La Trobe Health, St. Luke's Health, all with different variation. The extra benefit of this option is that you may also be able to lock in your current premium rate before the 1 April premium hike comes into effect. HIF, for instance, guarantees rate protection if you pay your premiums before that date. Depending how much your health fund decreases premiums by, this could result in an additional saving of at least 2.74% on average on next year's premium, and it could also be much higher than that, depending on how much your fund plans on increasing their premium. So by following these tips, you could save up to 44% off the normal cost of private health insurance, or even avoid paying private health insurance premiums entirely, while avoiding the worst financial penalties for not being insured. If you're interested to learn more ways to save money and grow your wealth, then I've included a few videos on the screen right now that can help. Also, please remember to hit the like button, as it helps to share these tips with others.